learners, welcome to the Academy of Commerce and Management. In this class, we are going to study the topic financial sector reforms. What do you mean by financial sector reforms? The financial sector reforms are the changes and developments occurred in the Indian financial system. These changes and developments happened in various areas such as banks, insurance market, capital market, stock exchanges, etc. These reforms help keep up with the changing financial needs. The importance of financial sector reforms is that it becomes necessary as the market grows. What are the objectives of financial sector reforms? First of all, the financial sector reforms aim to make the system stable. It should remain solid even in a financial crisis. Second objective is that the financial sector reforms help in effective resource allocation. It helps businesses and individuals get the necessary funding. The third objective is, these reforms made the financial health of different institutions better. Banks, insurance companies, and other businesses shall be stable and register profits. The fourth objective is the financial reforms ensure accessibility. That means it ensures that the services reach everywhere. People in remote locations should also have financial facilities. And the last objective is that the financial sector reforms help make businesses competitive. They ensure that Indian financial companies can cope with international standards. Now, let us discuss the need for financial sector reforms in India. The first need is that the colonial financial system had social and economic deprivation. This system was not focused on development. Instead, it was for the benefit of the Britishers. The second need was the presence of Mahalanobis economic strategy. However, it had a few limitations that came up in the 1980s. The third one was that the government planned to increase borrowings for higher financial activities. It provided these borrowings at concessional rates, but this step further led to a weakened market. The interest earnings were low, and there were several non-recoverable debts. The next one was that the banks further came under government control as they were nationalized. It significantly lowered the market force's role. Then, the higher government control also led to a bureaucratic structure. There were red tape issues. Also, it increased the non-performing assets for the banks. And, finally, there were some major events like the USSR end and the Middle East War. Such conditions also affected the foreign reserve. The important reforms that taken place in India were mainly based on the reports submitted by the Narasimhan Committee. The major suggestions of Narasimhan Committee were: Number 1, the committee suggested reductions in CASH reserve and statutory liquid ratio. The CRR was to be at 10% and SLR at 25%. The second one was the priority sector lending to small farmers, micro-businesses, and cottage industry. There should be a 10% fixed credit for the same. And, finally, the report suggested interest rate deregulation. It provided independence to the country's banks to set their interest rates. Now, let us see the important reforms happened in the Indian banking sector. The first reform was the reduction of the cash reserve and statutory liquidity ratios that provided more resources to the banks. They could lend these extra funds to industries like agriculture or small businesses. Another reform was that the banks got more independence with interest rates. There were no administered rates for bank deposits. Banks could decide for themselves. The next reform was that it allowed foreign and domestic private banks to have branches. It helped ensure that banks could independently increase operations. Another reform was that the presence of some major bodies such as tribunals, Lok Adalat, and civil courts. These bodies were intended to resolve matters of non-performing assets. And, finally, there was no further selective credit control. Banks could decide their lending terms and volume. Next, let us discuss the important reforms occurred in the debt market. The first reform was the removal of automatic monetization of the fiscal deficit policy. It allowed the government to borrow funds from the market sale of its securities. The second one was that the government borrowing's interest happens as per market forces. It has made the governments more cautious of the country's fiscal deficit. The third one was the introduction of 91-day Treasury bills, which helped with the short-term needs. These instruments also provided liquidity. And, finally, a delivery and payment settlement system were introduced to improve liquidity. Then, we can see the important foreign exchange market reforms. First one was the adoption of market-determined exchange rates. In addition, India introduced the current account convertibility in the year 1993. Second one was that commercial banks were allowed to participate in the foreign exchange market. It helped bring better international standards. The third one was that the currency swap transactions also began with new players in the market. However, these swap transactions still had certain limitations. The fourth one was the replacement of the FARA regulations with the FEMA. It led to higher freedom for India's foreign exchange system. And, the last one was that the exchange-traded derivatives were allowed to Indian non-residents and foreign investors. Now, we can see the major impacts of financial sector reforms. The first impact was that the Indian economy became more resilient and stable. The second impact was that the Indian economy successfully defended the Asian and global subprime crises of 1977 to 78. It was as a result of the stable banking system prevailing in India. The third impact was that the foreign and private banks increased the competition. It induced the banks to perform better. The fourth impact was that the Indian stock exchanges adopted international standards. It improves the overall performance. And, the last impact was that the financial sector reforms improvised economic measures like fiscal imbalance, public debt, and budget management. Finally, we can discuss the importance of the financial sector reforms. First one is, financial sector reforms answer the changing needs. It helps financial institutions cater to better living standards and increasing industry demands. Second one is, the financial sector reforms help go through various crises. The economy can handle such times when the financial system is solid. Third importance is, the financial sector reforms bring more competition. It helps in better standards and induces companies to grow. Fourth importance is these reforms are necessary to provide better credit facilities. The economy is driven by more demand and economic activities. And, the last one is the financial sector reforms aid the development of all sectors. Small businesses, agriculture, or other marginalized activities benefit from these changes. So, dear learners, this is all about today's class. Hope you are clear. So, see you soon with a new class. I request you to support us by subscribing to our channel. Please share our videos to your friends, colleagues. Once again, thank you.